Hello, and welcome to Portfolio Matters. In today's podcast, we will be continuing our review of the companies we've covered in historic share talks, and I'll be running through companies 11 to 20 in order of popularity. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, I'm going to be doing this on my own because Richard is very busy, he has a job, sadly. Okay, first up is Sylvania Platinum, which we covered back in February last year, and the share price was then 104p, and it is now 89.1p. So, if you'd held it throughout that period, you would have had a return of minus 11.4%. And our original view was positive. But I actually sold it and have recently bought back in because our regular viewers of the weekly will remember that the rhodium price went through the roof during last year. And as I thought the rhodium price got too high and was unsustainable, I sold, making a very nice return. Thank you very much. And I have recently bought back in. Okay, so a reminder of what Sylvania Platinum does. Sylvania Platinum is a recovery expert, i.e. it takes the tailings or the run of mine from chrome miners and then recovers platinum group metals from those tailings or the run of mine. And so that means it doesn't actually do the mining itself. And that is great when we are seeing rising energy prices and the energy of intensity of mining becomes much more expensive. And so Sylvania Platinum will be less affected than primary miners by the rising energy price. You'll see here the production profile of Sylvania. They're investing in Lesedi and Tweefontein, and that means their production profile will actually grow slightly over the coming years. And if we look at the PRIL split, they're mainly platinum, but actually the elevated rhodium price means that they make most of their profits from rhodium. And this is the rhodium price. So you see last year we had an astonishing rise in the rhodium price. Back in 2019, you got rhodium for $3,000 an ounce. And then mid last year, it approached $30,000 an ounce. And I thought that was unsustainable. So I sold my Sylvania Platinum shares. And that proved to be a good move because the rhodium price subsequently came off as car manufacturers had to shutter production because of the global chip shortage. And hopefully that global chip shortage is now beginning to ease. And you've seen recently the rhodium price has begun to spike back up. If you haven't watched our second video on Sylvania Platinum, I urge you to do so because it contains details of tightening global emission standards. And the main use of rhodium is in catalytic converters, and there is no good substitute for rhodium for converting NOx, breaking it down into constituent parts, into nitrogen and oxygen. So as global car manufacturers get back to work, get back to full production, you would expect rhodium demand to pick up. Now, a problem is that when car manufacturers shuttered their production, actually Sylvania Platinum and other PGM producers kept on at full production, and Sylvania Platinum was actually working through a backlog of tailings, and their production actually increased. So there will have been an increase in production of PGMs, which will create a surplus because demand collapsed, which will then need to be worked through. So I'm not expecting the rhodium price to spike back up anytime soon, but it has picked up surprisingly already, and that's very good for Sylvania Platinum. This is palladium price, which has not followed it really. And this is platinum, which again hasn't followed rhodium up. Okay, so in summary, Sylvania Platinum shares still look really good value there, and it's well placed to benefit from a recovery in rhodium demand, but PGM demand in general. And it's got a lot of cash, and there are prospects for further special dividends. So as of the 30th of September last year, Sylvania had cash of 133 million, and it's got a market cap of 330. So it's basically a third cash. Also, it's less exposed to rising energy prices than other PGM miners, as it's tailings recovery specialist, and the rhodium price, as we've seen, is ticking up. The one thing I'd say, the one danger, is that medium term, the world is converting to electric vehicles. And we recently had December UK car sales numbers, and 26% of new cars in the UK were fully electric, and a further 21% were hybrid. So it would seem, certainly in the UK, the transition is accelerating. But rhodium is particularly used in NOx conversion catalysts, and for diesel, emission standards are tightening, and there is no prospect anytime soon of big diesel trucks being converted to electric. So I foresee continued demand for rhodium for a long while yet. So our original view was positive, and Richard and I remain positive, and I have bought back in recently. Okay, moving on to number 12, Trident Royalties. We originally covered the company back in April last year. The podcast has since had 820 views, and the performance has been slightly disappointing, down 5%, so underperforming the market. But this is a long-term investment, and Trident have had a busy year. Now, we were originally mildly positive. This is the share price performance, and essentially it's basically been pretty flat, volatile around a stable mean. But the thing is, they've been really busy. We covered it back in April, and soon afterwards, they announced the Thacker Pass lithium royalty acquisition, and then in December last year, they announced a big transformative deal, which they purchased various live gold royalties. And this is the price of lithium. But sadly, Thacker Pass is not yet in operation, so it's not yet benefiting from this. But in a few years down the line, you would hope that Trident are going to start receiving serious royalties from Thacker Pass if the lithium price stays anywhere near current levels. Now, it recently bought a package of gold royalties, and the gold price has frankly been rather disappointing. And we're now entering into a rising interest rate environment, which historically has not been great for gold. And this is their portfolio of assets. And so on the x-axis, you have where the assets are in the life cycle. So actually very few of them are currently in production, and the big ones, the big recent ones. So Thacker Pass is some way from production. Lincoln is in production. Okay, so what's great about Trident is it's got a very busy and dynamic management. And really, since we covered it, it's done 2 enormous deals, and it is not the same company that we covered. Both those deals were successively the largest ones they'd done. And the Thacker Pass in particular could be really transformative when the mine comes into operation. Now, on the 13th of September, they announced this acquisition of a portfolio of gold offtake streams for $70 million, including, and to fund that as a mixture of debt and equity, and they issued $35 million worth of equity at 36p. But they've now bought live revenues. And so when we look at next year's revenues, suddenly you're going to have revenues of around 20 million in 2022. And that is on a market cap of about 123 million. So suddenly, this is a company which has the prospects of paying dividends starting next year, whereas previously cash flows were many years in the future. And it's quite difficult to analyze this company because it's changing so quickly. In summary, dynamic management, this is a long-term investment. When Thacker Pass comes into production, we'll see a big leap in revenues, but that is somewhere years off yet. And in the meantime, the recent gold acquisitions will start actually paying decent revenues very soon, or now. But I doubt very much they're going to be paying dividends. This is dynamic management. I expect that they're on the lookout for new deals, and they'll be continuing to add to the portfolio. So my investment case for Trident would be you're buying into a long-term story, and don't worry about the current share price. You're looking for long-term revenues as these early stage mining assets come into production, particularly Thacker Pass. So our original view was mildly positive. My view is now more positive. I like it. I should also say that I've traded in and out of these shares because in November last year, the Investors Chronicle came out with a buy recommendation on Trident Royalties, and the share price shot up 15%. And in one of my accounts, I sold the lot at, I believe, 41p. Now, whenever the Investors Chronicle does this, you know that spike is short term, caused by retail punters buying reflexively. And so I sold out and was waiting to buy back in, and I have bought back in below 37p. Okay, moving on to Petro Matad. So we covered this back in March, and the podcast has since had 820 views. We covered it at about 3p, and recently, last few days, the share price has ticked up to 3.3. So if you'd held it for the period, you would be up 10%. But it has been a volatile ride. This is the share price. We covered it back here. Share price, when they finally got the exploitation license, went through the roof. But then the company did a placing at 3.5p to raise $10.5 million to fund the Heron 1 well. And that basically destroyed the share price. We'll go into that in a bit. Okay, but a reminder of what the near-term production profile of Heron should be. So this chart here shows what they're planning, and it's a small field, but you know, if it can get to 8,000 barrels a day, that is a lot of money for a company with a market cap of £23 million. If Petro Matad can get Heron anywhere like these levels, and obviously we don't know what production is actually going to be until the first wells are in production, but if it can fulfill anywhere near its potential, then these shares are massively undervalued. That is before the exploration potential, which is enormous. Bear in mind that Mongolia remains massively underexplored. So this is Heron 1, and Heron 1 was found in an area where there are lots of other fields, known fields in operation, and each well will be quite cheap. Target cost $1 million. So the idea is they'll drill the first well to get Heron into production, and then they will use cash flow to drill subsequent wells. And moving on to exploration, there are some great prospects, and in particular, I like the look of Velociraptor. Now, you remember that Snow Leopard 1 found oil shows, but not commercial quantities of oil and gas. Well, they've now remapped and have a better idea of where to drill, and the Velociraptor target looks like a trap. That looks great. So they are searching for a farming partner in order to accelerate the exploration program. But if they fail to find a farming partner, they will be able to fund this themselves, but it could take a while because that will have to be funded out of cash flow from Heron. Okay, so in summary, finally, first oil in 2022, ? We hope so. Massive potential upside. I mean, if Petro Matad finally fulfills its potential, and it's been a very long ride for shareholders who have had to go through various exploration disappointments, but hopefully the first oil should mark a new chapter for the company. So it's been very frustrating. And now we have had a bit of a debate on the Discord channel recently about the competence of management, but I have been very disappointed with the handling of the $10.5 million raise, which was done at a big discount to the share price. And I personally feel that could have been handled much better. So I hope I'm wrong in my assessment of management, and that they will prove themselves to be more competent than I fear they are going forward. Let's wait and see. So first oil from Heron 1 is due in mid-22. Then there'll be further drilling of Heron 2 and 3. And they're searching for a farming partner. Market cap, so I said 23 million, it's currently 28 million. But even so, you get Heron production of 6,000 barrels a day. Bear in mind, they're saying it could peak at over 8. That would mean revenues of $145 million per annum at $70 a barrel. Now we can only guess at what their costs would be, but let's be really pessimistic and say it was $40 a barrel all in. You are still talking about multiples of the current market cap in annual profit. So if Petro Matad can fulfill its potential, this should be a proper multi-bagger. So original view was speculative, but they got the exploitation license and they're now moving into production. And I am strongly positive, with the caveat that I need to be convinced that the management can actually execute. Okay, moving on to James Fisher & Sons, the diversified marine services company, which we covered back in May. podcast had 800 views. The share price then was £10. And frankly, it has been a total disaster, and it has cost me personally a lot of money. So mea culpa, I got this wrong. Return is minus 56%, and that is after quite a strong bounce in recent weeks. So our original view was positive, and we were wrong. So we covered it round about in May, so around about here. And since then, it's been a total disaster. And the shares essentially fell off a cliff in October when there was a nasty profits warning, which we will go into. Okay, so mea culpa, what did I get wrong? Well, implicit in my coverage of James Fisher was the assumption that when the market recovered, the market for marine services recovered, that the share price would return to its pre-COVID levels. But we noticed that pre-COVID, the shares were on a PE ratio of 16. I did mention that in our podcast. So prior to COVID, the company was being valued as a growth company. And then growth failed to materialize. It's heavily indebted, and oil company capex has remained very subdued. So although revenue growth, there was some revenue growth, it was very disappointing. And then there was a profits warning in October, and the market completely re-rated James Fisher downwards, not helped by the fact that the company has a lot of debt, and it mentioned that it was in compliance with its banking covenants, with the implication that there was a danger that it could breach them, and that is always bad. So where are we now? Well, profits in the profits warning in October, actually, it didn't really downgrade earnings by very much. It was more the tone. The tone was relentlessly negative, and the market took that very badly. The revenues it reported were still growing, and it actually downgraded earnings expectation by only a few percent. But capex in the oil and gas industry remains subdued and remains a drag on James Fisher. So it is, revenues are recovering, but only slowly, and it's heavily indebted, but trading within its banking covenants. Now, recently, the most recent RNS announced the recovery of a bad debt from a Mozambique LNG project and reiterated guidance for the coming year, and reiterated the fact it was trading within banking covenants, and that has reassured the markets, and the share price has recovered from a low of around £3 to around £4.38 now. So actually, in percentage terms, that is a good bounce. It's just, we looked at the shares when they were £10, and the shares were down a long way from there. Now, guidance for 21 are underlying operating profit, so not net profit, of between 27 and 32 million pounds, and the market cap's around 200 million. So estimate a post-tax P ratio of around 10, i.e. not cheap. But if capex returns to the oil and gas industry, then James Fisher is well placed, and it's also got exposure to renewables, as we covered in our original podcast. So it is well placed for a global recovery in marine services. So we were then positive. I'm still positive. And, you know, I bought more in recent weeks, which is, buying your losers is not a recommended investment strategy, but I now think the shares are actually seriously undervalued, although they're on a P ratio of 10. So, you hope that with recovery in the underlying markets, James Fisher should head back towards where we initially recommended it. But now it's going to be a struggle for me to break even on this investment. Okay, on to Petrofac, the oil services company. So we covered it back in February, and the podcast had 780 views. We covered it at 132p, and it's now 131. So if you'd held it over that period, you'd be down 0.9%, but again, you'd have had a hell of a volatile ride. So we covered it back in February, and essentially the share price has oscillated with the progress of its dealings with the Serious Fraud Office. And you see that in September, it came to an agreement with the Serious Fraud Office, and its share price shot up. And if you'd sold it then, you would have done very well. So it pleaded guilty to the charge of failing to prevent its employees from offering bribes to secure business in Iraq, Saudi Arabia, and the UAE during the period 2012 to 2015. And it was fined $106 million. It then had to raise $275 million to pay both the fine and to restructure some of its debts, and it did that at 115p. But the SFO problems should all be behind it now. Although you'll remember that it has been explicitly blacklisted from bidding in the UAE because of the charges from the SFO, and that it had failed to win any bids in Saudi Arabia and Iraq following the problems with the SFO. And the company appears confident that it will get the blacklisting in the UAE lifted in 2022, but will it gain any bids, any business in Saudi Arabia or Iraq going forward? Now, bear in mind that it won business there previously through bribery. So don't know. Its most recent RNS announced that the order intake in the second half of 2021 has accelerated markedly. So new orders of 1.5 billion in H2 compared to $500 million in H1. So that's great. And included in its bid pipeline of 40 billion is 7 billion in new energies, i.e. hydrogen and wind farms, etc. And it's announced a strategic partnership with Gazprom. But as we covered in our original share talk, it is a capital-intensive, low-margin business with a history of expensive cost overruns on fixed-price contracts, and because it's low margin, cost overruns on one big project can destroy years' worth of profits. So we thought the shares were speculative then, based on settlement with the SFO. Then this could recover, and it's now had that settlement with the SFO, and I still think they're speculative. Essentially, this is a low margin business, but if they start getting business from Iraq and Saudi Arabia and the UAE again, then it has shares have potential to recover to back where they were 2 or 3 years ago. And bear in mind that the shares were then trading well over £10. Okay, moving on to i3 Energy, and we covered that in October, and the podcast has since had 750 views. The share price was then 3.49p and is now 3.4. So share price is down 0.7%. and we then were strongly positive. Straight after our positive share talk, the shares drifted right down, and at one stage were around 10p. So it's then recently staged a recovery, and we are about flat. And I was strongly positive, and I remain strongly positive. So a reminder, i3 have assets in the North Sea, but during COVID, they acquired a load of Canadian assets at a very good time when the oil price was very depressed. And they have since, so they've gone from having no production to actually quite exciting and interesting Canadian production assets. And one thing I failed to bring out in our original share talk was the potential of their assets in the Clearwater, which is, and I quote, probably the most economic play in the history of Canadian oil, with internal rates of returns of over 500% plus in the tier 1 acreage. And i3 have a small interest in the Clearwater, which looks quite exciting. It is due to grow production to over 20,000 barrels a day in 2022. It's announced its first dividends and is on a dividend yield of 8% plus, and it's committed to paying out 30% of free cash flow. So it's gone from, a company with no assets a couple of years ago, no production assets a couple of years ago, to one which is going to be kicking off a lot of cash and paying out very good dividends. And we like the management who have put all this together and are looking for assets to build a bigger portfolio in Canada, although obviously the rising oil price is going to make that more difficult. And it acquired its Canadian portfolio from companies that had neglected them, basically. And so there are quite a lot of good drill targets, which is beginning to exploit. And so it will be drilling 17 wells in 2022, and that will add 5,250 barrels a day of new production. Obviously, the existing portfolio will be depleting and declining over the period. So you won't get an increase in total production of 5,000 barrels. You'll go to hopefully over 20,000 barrels, peaking at 21,000 barrels in 2022 from year-end 2021 production of 18,000 barrels. Now, one thing that we have heard nothing about is the Serenity field in the North Sea, which was originally i3's big asset and which they have farmed out. Now, their farming partner was due to demonstrate that they had the cash to develop the field. And frankly, we have been here before. This previous farming partner failed to show they had the cash. And we're awaiting news from i3 that their latest farming partner can do it. Now, we have had no news, but if we were to get news on the Serenity farm out, that in itself would be transformatory to i3. So there are lots to look forward to for i3, and we were strongly positive then. I'm strongly positive now. And actually, after listening to the feedback from our original share talk, I bought a lot more. Okay, moving on to Serica Energy. Now, we covered the podcast in September, and the podcast has since had 700 views. The share price was then about 188. It's now 244p, return of almost 30%. We were then positive, and the share prices has a good run because, and we've covered this extensively in the weekly, we have run into a European gas crisis. And this is UK gas futures. You'll see since September, the UK gas price has shot up to a peak of over 450 from 125 at the beginning of September. And despite coming off recently on good weather and LNG cargoes from the US, it remains elevated. And that is great for Serica, which is 80% gas. And this is the production profile of Serica. Remember, their Columbus field has just come online, but is not producing at full capacity because 40's export pipeline is full. And so they haven't been able to export full production, but that should change in 2022. Then Columbus should be producing at full capacity. In 2021, the Serica will produce at a rate of between 23 and 25,000 barrels a day, and that will rise to an average of around 30,000 barrels, so up 20% in 2022, hopefully, in a gas market that is very strong. So, in summary, well placed to benefit from European gas prices, but above all, remember it's going to get a massive uplift in revenues in 2022 because it bought all these fields from BP, and there was a profit sharing agreement with BP that meant that BP will get 40% of the revenues up until the 31st of December 2021. So moving into 2022, Serica will get all the revenues from the Bruce, Keith and Rum fields, and therefore its earnings will rise 67%. So given we've got very high gas prices and their revenues are going to rise 67%, I remain very positive on Serica. Plus we've got the Columbus field, and we also have the North Egg exploration well in 2022. So that's something to look forward to. And hopefully, with rising revenues, they can start paying out serious dividends. And they are searching for acquisitions in the North Sea. And we know that there are a lot of good assets searching for funding. We were then positive. I'm now strongly positive, frankly, despite the rise in the price. Okay, now on to Solgold. So this is the data from our second Solgold podcast, which we did in February, and since then 700 views. The share price was then 21.2p. It's now 25.8p. Return of plus 7%. Now, you remember that we did two podcasts on Solgold. The first one was positive, and then we read a negative piece on Solgold by a hedge fund, which was pointing out that the Alpala resource was very deep. And that would mean that it was going to be very expensive to develop, and questioning whether it would ever get developed. This is share price, which has been volatile, but essentially over the period has gone nowhere. And if we look at the mining life cycle, you see that I think Solgold is stuck here. It's got loads of exploration licenses in Ecuador, all of which look really exciting, but the big Alpala mine is stuck in feasibility and development, and who knows when it'll come online, because there's been a lot of corporate shenanigans going on with Solgold. Its shareholder BHP have been getting their members on the board and have instigated a wholesale changes in the management team, resulting in the CEO stepping down, we are still awaiting the Alpala pre-feasibility study, and they're changing the way they're thinking about developing it. So we'll just have to wait and see what happens. But the Alpala development will cost between 2.5 and 3 billion, according to the former preliminary economic assessment, which has since been withdrawn for the website as they reconsider how they're going to develop the mine. And, you know, in order for shareholders to do well, that funding will have to be not massively dilutive to existing shareholders. So, not sure. Though the concern would be that an element of that has to come from existing shareholders and would be done at a big discount to the share price. So, would be a concern. And in the best case, production is still many years away. And reminder, the market cap is 870 million. Honestly, too difficult. Our original view was negative. Now I just don't have an idea, actually. It's market cap's very high, and there are much better opportunities out there, if you ask me. So I am going to cease coverage, actually. Okay, on to Atalaya Mining, which we covered in November, and the podcast has since had 640 views. Share price was then 399p and is now 431p, having come up in the last few days. So you're up 8%, which is decent return. And we were then positive. This is the share price. It's ticked up nicely in recent days. And this, we said, was an income play. It's not really a speculative multi-bagger. It's a well-managed European copper miner with assets in Spain, and is a low-risk income play on the copper market. It pays inaugural dividend of around 7%. The mine, the Rio Tinto mine, has now reached its operational plateau of processing around 15 million tons of ore per annum. And in order to see higher production from Atalaya, you would have to either see higher ore grades, and the ore grades vary depending on what part of the mine they are exploiting, or higher recovery rates. Now, in recent days, they have announced that the Elix plant they've started construction of an industrial scale version. Now, we don't know much about the Elix process, which seems to have been developed by a former Rio Tinto metallurgist, and it aims to recover copper, zinc, and precious metals on site. Now, remember that currently concentrate is being trucked to the coast to be being processed there by Freeport McMoran. So this would mean more of it is processed on site, and that saves a lot of cost in transport, and is also reduces their carbon emissions and presumably cuts costs. So that is all good, but we don't really know enough about it to evaluate how much it is going to save them. So something to watch. They've also started construction on a 50 megawatt solar farm to provide power for the site. That's all good. And it's recently acquired some nickel exploration licenses in Spain. But as we covered in the original podcast, you know, everything you do in Spain, you are going to suffer from protests from environmentalists, and getting new mine development licenses is going to be tough. So expansion is going to be beset by environmental and regulatory hurdles. So original view, positive. Current view, positive. I like it as a yield play geared to the copper market, and we also like management. And finally, Jersey Oil and Gas, which we covered back in May. The podcast has had 630 views, and share price was 156p. It's now 139p, and the return is minus 10%, and we were then strongly negative. Now, if you haven't seen our original Share Talk, and we do get new members of the Discord channel, for example, who hold the shares and haven't watched our Share Talk, I urge you to do so, because the story behind our Share Talk on Jersey Oil and Gas is that we were contacted by somebody within the oil and gas industry who was concerned about the commercial viability of Jersey Oil and Gas's plans and wanted to alert small investors to the risks. And so we did a lot of work with him before putting together that podcast, which goes into the Buchan field in some detail. And essentially, our view has not changed. So to recap, we think the Greater Buchan area is an old field, and BP and Talisman took out a lot of oil from that field. There is undoubtedly oil left, but we really question whether Jersey Oil and Gas's estimates of how much oil remains are realistic, because in particular, they seem to be counting oil which is below the oil-water contact. And we wonder whether that is at all possible. So will they manage to find a farming partner willing to invest 2 billion sterling to develop it? We are deeply skeptical. So if you have the shares, please watch our podcast. We were then strongly negative. We remain strongly negative. We think there are better opportunities out there. Okay, that is it. I'm afraid you've just had me today because Richard is very busy. And I will continue to run through the remaining Share Talk companies, and we'll be doing a new batch probably in a couple of weeks. In the meantime, please can you press like and subscribe to the channel. And it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.